If you're saving towards retirement, the big question is this. Once you retire and start drawing on your portfolio, how much will you be able to draw without fear of running out of money? My name is Jaco Jordaan with Riverchase Wealth Management, and this is a common question when we work with clients saving for retirement. The answer, of course, is a little bit more complex. You may have heard of the 4% rule, which I think remains a good rule of thumb as a starting point for discussions. A few years ago, Dave Ramsey stirred the pot by saying the safe withdrawal rate should be closer to 8% per year. I believe he called the 4% crowd
4% withdrawal rate morons.
So is it 4%, 8%, or some other number? To understand what a reasonable withdrawal rate might be, let's start by revisiting the 4% rule and then look at why so many planners disagree with Dave Ramsey. Finally, we'll take a look at other variables that influence your withdrawal rate. Let's start with the 4% rule. The 4% rule was popularized by Bill Bengen, a financial advisor who in 1994 wrote an article in the Journal of Financial Planning titled Determining Withdrawal Rates Using Historical Data. Bill took a very logical approach to finding the answer. He started with a 50-50 portfolio of intermediate treasuries and U.S. stocks with performance data from 1926 through 1993. He then said, let's assume somebody retired in 1926 at the start of the data series, and applying different withdrawal rates, 3%, 4%, 5%, etc., and adjusting spending by inflation each year, how long before the portfolio ran out of money? He then repeated the test for somebody who retired in 1927, 1928, and so on. By testing different withdrawal rates, 3, 4, 5%, he found that 3% starting withdrawal rate would generally last at least 50 years and likely even longer. In fact, he limited results to 50 years under the presumption that nobody is retiring for more than 50 years. A 4% starting withdrawal rate lasted at least 32 years. A 5% withdrawal rate showed investors retiring in the mid-1960s, depleting their portfolios at around 20 years due to the low return and inflation shock decade of the 1970s. And so, the 4% rule was born. Over the historical period of 1926 through 1993, regardless of when someone retired, if they stuck to a 4% withdrawal rate plus inflation, their 50-50 portfolio lasted at least 30 years. But we should probably dig into those results even further. There were 51 test periods in that data set. For 41 of the periods, the money lasted at least 50 years. That is, a 4% distribution rate ended up being far too conservative. For 10 of the periods, the money lasted less than 50 years, and for 4 of the periods, the money lasted less than 40 years, with the worst performing period running out of money at 32 years. And so, the 4% rule was based on the worst experience in that data set. In fact, as this slide shows, the average maximum withdrawal rate was closer to 7%. I think this is why Dave Ramsey says that the 4% rule is ridiculous. The data does show that most of the time, 4% was too conservative. I'm fine with that critique, but he then goes further and says that because equities have averaged between 11 and 12%, and inflation around 3%, you should be able to take 8% inflation adjusted off your portfolio. Interestingly, the original Bengen research didn't even include charts for withdrawal rates above 7%, as they were too high to be practical for a new retiree. His or her capital would be exhausted very quickly in most cases. So to explain the discrepancy, we need to look at the math. If a portfolio returned 11% every single year, and if inflation came in at 3% every single year, then Dave Ramsey would be absolutely correct. You could take 8% off that portfolio and be fine. Unfortunately, market returns do not come to us evenly like that. In fact, despite a long-term average of roughly 10%, annual returns fell between 8 and 12% only 7 times in the 100 years between 1926 and 2025. Markets move up and down, sometimes by a lot. And that impacts how much you can take off the portfolio. Even in the longer term, returns are not stable enough to support an 8% withdrawal rate. This graph shows the 20-year rolling return of the Fama French large cap series from 1926 to 2024. While there definitely are periods, long periods even, where an 8% inflation-adjusted withdrawal rate could have been sustained, much of the return profile shown here falls below the required rate to sustain such a high withdrawal rate. As is always the problem in financial planning and investing, we don't know what the future holds. Will the next 20 years look like the periods where 8% distributions were sustainable? Or will it look like periods where we needed to be more cautious? Of course, the problem with market volatility exists even at a 4% distribution rate, but the magnitude of the problem that's created by the volatility is such that the funds can last at least 32 years. Given that the study was originally done in 1994, is the 4% rate still reasonable? Bengen himself has recently addressed some of the flaws in his study. He started by pointing out that most portfolios today do not simply consist of intermediate treasuries and U.S. stocks. Modern portfolios include international developed and emerging market stocks, small caps, corporate bonds, high-yield bonds, potentially alternative investments such as real estate. From a theoretical perspective, these more diversified portfolios should provide a lower level of volatility and equivalent levels of return. And if we can achieve lower volatility without significantly reducing portfolio return, we should be able to sustain a higher spend rate. In 2025, Bengen updated his research to show a 4.7% spend rate, which he rounded 5% because a 4.7% rule doesn't have much marketing appeal. The reality is that Bengen's study and Dave Ramsey's comments ignore a lot of important variables which really should be considered. The biggest shortcoming of the Bengen study is the rigid application of an unchanging withdrawal rate each and every year. In fact, various studies, most notably by Jonathan Guyton and William Klinger, have estimated that initial withdrawal rates may be as high as 5.2 to 5.6% if you build in flexibility to take a little less when markets are down and more when they've recovered. The point is, a dynamic approach can lead to a higher average sustainable withdrawal rate over time than a rigid application of an inflation-adjusted withdrawal rate. Something else to think about is how spending is likely to change over the retirement horizon. And we often project spending that remains level throughout retirement on an inflation-adjusted basis. In reality, spending changes as retirees move from the just retired go-go years to the I'm getting tired of traveling slow-go years to the I'm not going anywhere and you can't make me no-go years. This slowing of spending over time has been confirmed in data from JP Morgan's Retirement by the Numbers study, which looked at actual retiree spending data through Chase checking and credit cards. There's a lot of research confirming what has become known as the retirement spending smile, where spending starts high, then drops as lifestyle slows, then picks up again as medical expenses increase. The point of all this is, while a 4% draw rate is a reasonable starting point for a portfolio withdrawal discussion, every investor's financial situation is unique, as every family has different balance of taxable, deferred, tax-free accounts, which can result in widely varying tax burdens. Some have guaranteed pensions, Social Security strategies differ, how conservative or aggressive clients are willing to invest differs, and the flexibility to adjust spending will differ between clients with significant fixed expenses, like a mortgage that carries into retirement, versus those who live debt-free and have mostly discretionary expenses. That doesn't even address the time horizon, as those who are healthy and retiring in their 60s potentially have a much longer planning horizon than someone finally retiring in their early 70s in poor health. And finally, some consideration has to be given to reserving some of the portfolio for the possibility of long-term care expenses. As you probably can see, this gets complicated quickly, and we can't just apply a simple fixed percentage to all investors equally. That's why we help clients to understand the nuance of their personal financial situations in order to figure out what their personal spending rate should be. If you'd like to find out more, our contact info is in the description below. And if you like this video, please like and subscribe to our channel. Thank you.